Breathe a sigh of relief. You made it to Strongly Financial, a weekly live web series dedicated to elevating your financial literacy and cultivating your overall health and well-being. Your co-hosts are Dr. Michael A. Wright and Ali Leonard. Their respective expertise in holistic wellness and financial consulting positions them perfectly to guide you toward optimal well-being and unrivaled financial success. Please allow me to introduce them further. The incomparable Ali Leonard. As a credit guru, Mr. Leonard has dedicated himself to fostering financial literacy in students of all ages. He has developed a comprehensive credit awareness curriculum that is suitable for elementary, high school, and college students. Mr. Leonard has traveled the country, providing credit awareness seminars to high schools, colleges, churches, and private organizations. Mr. Leonard has worked tirelessly with federal credit agencies, financial services, and real estate agencies, earning a strong reputation for his professionalism and expertise. Mr. Leonard is committed to educating and training consumers as well as assisting them practically to fix their credit. The company he founded, Financial Services Unlimited, offers credit consultation, credit services, and financial services including insurance for financial repair and wealth management. Join his supportive online community, FSU team, empowering you to take control of your financial future. Dr. Michael A. Wright. Dr. Michael A. Wright is a highly accomplished and respected professional in the fields of social work, coaching, publishing, and consulting. With a wealth of experience and expertise, he has dedicated his career to helping individuals and organizations achieve their goals and make a positive impact in their communities. As the CEO and lead executive coach at More Media Group, Dr. Wright specializes in helping individuals tell their stories and translate their ideas into capital. With interventions based on his signature contribution, creating opportunities and changing horizons, the coach method, he continues to focus on trauma-informed, holistic, and transformational approaches to personal and professional development. Join the vibrant online community at wealthcarebymoremedia.com, where he promotes practical habits of health in 4 key domains: brain, body, mind, and spirit. And I am your virtual host, Bartholomew Socrates. You can call me Bart. I introduce the ideas, the segments, and the opportunities as we explore the intersection of health and wealth weekly on Strongly Financial.
Hello, it's time again.
What's going on?
Of course, on location. What are you two up to?
We are looking forward to this evening.
Trying to get things all set up over here.
Yeah. Still trying to kind of work it out. You know, as you can see, I got a different background. So, yeah. All right, trying to make it happen.
I had to bring them into my area.
Yeah.
Makes sense.
What you got going on?
Well, I am very happy to have you as our guest today. We're going to do a little different format today, as well as respect the fact that my internet connection
Oh,
is not the best.
okay.
Is horrible.
Yes, it is.
Oh, Lord.
That's okay.
So,
We got your back, though.
Ali, it's on you
Holly is on you.
to give all the juice tonight and make sure we get all the information. To welcome.
Okay, that was
All
that
right.
was the end of him.
All right, he's gone. Well, maybe he's trying to come back.
It's the
He's
shaky
gone.
Wi-Fi. The shaky Wi-Fi.
All right, Dr. Michael Wright is somewhere in Cancun or something. I mean, his internet is not working properly, so I'm going to be running the show along with my partner in crime, my wife,
That'd be me.
Sharifa Leonard. And this is episode number 12.
Yes.
And we're not going to have Bart tonight. So we ain't gonna do it.
It's okay.
It's okay though.
We're gonna make it through.
We just gonna flow. All right. Last week, as we were ending, I call him Michael. Some of y'all might call him Dr. Wright, or but he wanted to talk about insurance for your whole life. And not just whole life insurance, but for your entire life span. So, I mean, we want to be able to break down some different concepts of life insurance, wording and meanings, and that's why the beautiful Sharifa Leonard is here.
That'd be me.
To kind of talk about the life insurance and the benefits of it. And so, you want to jump in? You want me to continue to kind of?
Well, we're going to talk about. I think Dr. Wright wanted us to go over different kinds of insurance, not just different kinds. Life insurance is one kind of insurance. So I'm going to just cover what insurance is. We have life, we can have health, we have car insurance, which is, in most states it is definitely mandatory. And a lot of states are making life insurance mandatory as well. So you have homeowners insurance. Yes. Just a lot of different kinds of insurance. Insurance is meant to protect you from loss or what could be a loss. So you're paying in advance for something that could happen down the road. So it's a good thing to have, and a lot of people really try to insure for catastrophe and for for life, for if you have a car accident, fire, so it's really a good idea to understand what insurance is meant for, why you want to have adequate insurance. We deal primarily in life insurance,
and that's what we're going to talk about really tonight.
I can go over just a brief synopsis of it all, because it all kind of is the same thing. But
this is your show.
Okay.
So I'm going to let you roll with how you want to roll.
Okay.
You want to talk about a combination of things.
Okay. So for insurance, I'm going to go over some key terms like deductible, copay, premium. Okay. So that you guys can understand a little bit better. Now, when we deal with health insurance, you deal a lot of times with deductibles and copays. Health insurance is can be offered through the job, but a lot of people like entrepreneurs, they'll get private health insurance. You can also go to the marketplace. The government now offers insurance. So, you know, then this is for health. So as far as understanding that, and you got to understand that the higher deductible, the lower the premiums usually are, especially for health insurance. So if you pay more, if you are paying, if you have a higher deductible, the reason that they do it like that is hopefully to lower your payments, especially on health and car insurance or auto insurance. And so, there's Michael coming back in. Oh, he must be getting some good Wi-Fi. Going back out. Never mind. Okay. So in health insurance, I know like if you get health insurance through your job, it's a set amount. As far as if you have a deductible, you pay a set amount for the year, and that can go up yearly. So, you know, health insurance is very important because it protects you financially from sickness and illness. So, I mean, it doesn't protect you as in not getting it, but if you have to pay for it, you'll have the health insurance to kind of help back up and ease the costs from your pocket. Okay. And then we have car insurance. That's mandatory in most of the states. Okay. Same thing. So high deductibles mean lower monthly payments. And so, you know, when you're going in to purchase the health insurance or the auto insurance, just be mindful of that. The deductible is the amount of money that the insured, must pay before the insurance policy will kick in and start to pay. So I know with auto, you can have a 500. Some may have even 250, depending on your driving, how well you drive. And so, yeah, just make sure you understand deductible, co-pays are what you have to put out of your pocket at the time of service at the doctor's office. So, yeah, be mindful of that. Now, premiums are a monthly payment that you may have. I know life insurance, this is how you're paying into your life insurance. It's usually a set amount agreed on before you sign the contract. Usually you'll get a quote. And so you know what your amount is going to be every month. And so, yeah, so we just want to browse over those few terms so that you would have a good understanding of that. And then, like I said, we concentrate on life insurance and helping our clients understand what it is, the different types that you can have, and the benefits. Yeah, and so that's it. You can step in there.
I can say some now. And you know, for us, I mean, this is really a subject that's very important to us because it's too many families that are having to have GoFundMe's on Facebook, Instagram, selling plates, to raise money, soliciting money, to bury one of our loved ones. And then the other piece of that is, we're not leaving any type of wealth for the generations behind us. So that means that we're all having to start from zero. Once somebody, passes away, big mama, no insurance or very little insurance. So how can she pass something on to her children or her grandchildren? And one of the ways to do that is really through life insurance. It's really one of to us, one of the well-kept secrets that's out there. And we need to take advantage of it, because one of the things that's going to happen is you are born to die. So you're not immortal. So you are going to leave this earth, this physical body, and go into the spiritual realm. But that's another conversation. So you really need to prepare yourself um, for that time, because we don't know the date or the time or the month or the year. So we have to plan accordingly ahead of time. So we can be able to build some of this generational wealth and pass it on. And Sharif is going to kind of break down, the different types that's kind of out there, and the meaning of them, the definition, and really the benefits or the cons when it comes to life, not life, term and whole life, IUL, all that good stuff. So the floor is yours again.
Thank you. So I want to first talk about the stigmas that are attached to life insurance.
Help us.
There are a lot of stigmas. I've heard so much. When you talk about life insurance, people, they just, you just see a whole new, like a whole different kind of spirit that comes over them. And they're like, oh, okay, let me talk about it. Okay. So life insurance is meant to protect whoever your loved ones from financial ruin. Okay. And so we have to be mindful. You want to be prepared. It's better to be on the prepared side than the unprepared side. If something happens to you, you have to think about what their struggles are going to be, especially if you are the primary breadwinner in the family.
Right.
And so that's important, especially if it's someone that you really, really care and love, and you want to see like your children be able to go to college, be able to do some of the things.
Grandchildren too.
And grandchildren, yes, the family, whoever's left here. And so the stigmas, the importance of it far outweighs the stigmas attached to it. And so we have to begin to change our perspective about how we think about life insurance. I know in the past there's been some horrible things that have happened, and just crazy things where people have done bad things to other people, to their children. I've heard some horrible things.
Yes.
We have got to get over that, because we are missing out on a major part of creating legacy for our children, for our grandchildren, because we too afraid to face, the ultimate thing that could happen to all of us is death.
Death, yeah.
Okay, and you have to have a different perspective about that.
I got to add something here. Hold on.
Okay, go ahead.
We've had a lot of conversation with individuals, husband and wife, parents and children. The husband saying, well, I'm not going to, I don't want no life insurance because I don't, if I pass away, I don't want no other man, benefiting off of, the money that I'm leaving for her. And then, a father saying, well, I'm not going to leave nothing for my trifling and kids. They don't even call me unless they want some. You know what I'm saying?
That is not love.
That's crazy.
That is not love.
Yeah.
We've got to think about what you're saying. That's very selfish.
It is.
And if you have the opportunity to participate in having life insurance and having enough, coverage for your family, where is your love at if you wouldn't want to leave them in a better place, a better state if something happened to you?
Exactly. And then if you don't leave no life insurance, she's gonna definitely go get a man, because she's gonna need some support. Quicker.
So the stigmas, the importance have to outweigh the stigmas that we have and the belief systems that have been placed on us about life insurance. It's some of this stuff. If we continue in that frame of mind, we'll never start to leave legacy and build legacy and all that. It won't happen, because our mindsets are too negative. Okay, you've got to open your mind and allow yourself to think a little bit more than just being selfish.
Right.
And so that was some of the things that we have come across with people. It's just, it's just not a good thought process to have when you're dealing and learning more about insurance and how it works.
And people even say that, when you start talking about life insurance or getting life insurance, what I'm saying, you're going to be making your death come faster, or you're going to die sooner. I mean, I know. But that's what it's a lot of people think like that, though. I'm telling you, we done heard it all, for sure.
And we have. But it's got to change.
Right.
It's got to change. And if you are that one in your family that has decided that you're going to be the change agent for the family and set the example, make sure that you are teaching the ones, that are not familiar with the process and don't understand the process, because sometimes we have to help coach and guide people through it and help them, understand the good side of it,
right,
and not dwell on the negative side of things. And so, yeah, so that perspective shift is definitely needed. It's a smart planning. Life insurance is smart planning for your future.
Yes, it is.
And so you definitely want to take advantage of it. So we have permanent. This is how I like to break it down. You have permanent insurance and you have what we kind of consider as temporary insurance. Permanent insurances are like your whole life, and this is dealing with life insurance, your whole life, your IULs, your ULs. They usually will cover the whole lifetime, up to 120 years. You are building up cash value in the policy. There are several types of whole life or permanent policies. Some can act as just a regular whole life policy. Some are IULs can act as, I don't want to say investment tools because they don't want us to use that. It's still a life insurance policy, but it allows you to grow a cash value faster. Okay. And that's called an IUL.
What does IUL stand for? For those who don't really know.
Indexed Universal Life.
There you go.
Indexed Universal Life. And a lot of times that policy is used to build your family bank, or what's the other bank that they call it? Infinite banking.
Yes.
Infinite banking and family bank. So we do a lot of those policies, because we like to help people start to learn or take advantage of the interests that you're gaining back on that policy. And whatever your premiums are, part of your premiums are going to be invested or put into a index fund so that it can gain growth over a certain period of time. And then the money starts to, what do you call it?
Compound.
And so we do a lot of those, and we actually, I think, prefer to put people in those as opposed to the term policy.
Well, and can you break down as far as the IUL, and maybe I'm asking this question too soon. Maybe you're gonna do that a little bit down the road. Okay, all right, be quiet.
I don't know. Come on with it.
I mean, as far as showing them the benefits of having an IUL, as far as the taxes and you're borrowing against it,
Okay.
and guaranteed to never lose, and you already said compounding, but
okay. Okay. So for the IUL, all the things he just said, the benefits, the benefits.
I said that myself, huh?
Yeah,
Okay.
you did say.
Right, I'm sorry.
The benefits of having an IUL, it's tax free, so your money is accumulating and you pull it out in the form of a loan.
Right.
Okay. So make sure you understand that because most life insurance policies are not taxed anyway. So that's why they let you get in the form of a loan. And you definitely want to put it back in there.
Right.
Because some companies will allow you to take money out and still use that, whatever your initial amount of money that you have in there. So you're gaining your interest still on your premium amounts that you put in there. But that's why you have to be very careful. Make sure you check with your company, the company that you're using, to see that you're not, if you pull money out, making sure that you're still able to keep that gaining your interest on the money that you pulled out.
Right.
Okay. And so you have the tax part of it, the tax advantage. Our companies that we use, you have your living benefits. Okay, that's another plus.
Oh yeah, I ain't forgot about that.
He didn't mention that.
I ain't mentioned that one. Yeah.
Living benefits are, if, say for instance, you get critically ill or critically injured, you have to be in the hospital for an extended amount of time. And so at that time, you're not really able to work or make any money. So you can pull up to, depending on the company, 70 to 80% of your life insurance money. You can pull it out and still use it while you're living, but it has to qualify through your doctor. They have to sign off on it. So that's critical illness, terminal illness, and
give some examples.
Chronically ill
of those, like heart attacks and strokes.
Yeah, if you've had a heart attack and you've had to be in the hospital for an extended 6 months or 3 to 6 months or what, extended period of time. Or if you were in a car accident or you're not able to work for an extended period of time. Terminal illness, diagnosed with cancer or some kind of disease process that will not allow you to work. So you can have this money, 70 to 80% of this money sitting there for you to pull down so that you will be able, and that's 70, 80% of the death benefit.
Death benefit. Not your cash value, but the death benefit. Yeah.
And so you just have to make sure, of course, you're getting everything signed off on as far as the doctors are concerned. And it's submitted to the insurance company. And so, that's a good benefit to have. I've had people, I'm a nurse by trade, and I've had people that have had that benefit and they didn't know. And when they found out, it was like they were so relieved because they knew they were going to have a major surgery and be off work for a long time. And in the hospital, and you've already finding out bad news that you have to have this. And then, so to have that sitting there, it was just like a total weight lifted off of his shoulders. And so,
Exactly.
he went into the surgery on a positive note. And so, yeah, so we got tax advantages, we got the living benefit, we got the cash accumulation with the interest rate. Compounding interest.
Yes.
And so if funded correctly.
There's one more.
Oh, did I miss something?
You can't lose. You can't lose any money in these kind of policies as well.
Okay.
Yeah, it's on your cash value side of it. Yeah.
So what he's saying is your money is being, I don't like to use the word invested because you're not supposed to, but your money goes into a fund. It can be the S&P 500. It's whatever fund that that insurance company uses. And so it's protected at a floor, a 0%. That means that you cannot ever lose, even though it's in the market and the market may be going up and down and side to side, you will never lose. Okay. Your money will always be at a certain, growing at a certain rate. And if the market does horrible that year, the worst thing that happens is that you won't get a certain amount put into your policy. So your floor is zero. You won't ever go down in your money. It'll always, usually even in bad times, you get some kind of return, whether it's a 1 or 2%, whatever, return, up to about 6 or 7 is what I've seen in the past. And so, and then some companies for the first year to 2 years, they offer a bonus up to 12%. And so, yeah, that's a good thing. If you can get a good company that is offering a bonus on the IUL, that would definitely help you out. But we have to see how it's set up in there. Is that doing you pretty good?
I think that's pretty good on that side of it. Now,
we still got to do the term,
yeah,
so that people can understand.
Well, and then even with these IULs or life insurance policies, period, the younger you are, the cheaper it is for you to, pay this premium, or the premium that's going to be offered to you is going to be a whole lot less. So the earlier you start, the better. And if you think about it, starting early, grandchildren, children when they 2-3 years old, and another key point to that is, of course, overfunding. But if you think about it, this price that you're paying now, even though the cost of insurance is going to be going up, that's one of the reasons why you want to overfund it. But as far as your rate when you 10 and you're trying to get some insurance when you're 50, it's going to be a major increase in your premium. So you want to start early to get that in place so you can start, generating that. But
let me talk about overfunding.
Yeah.
Overfunding. This is what we mean. So say, for instance, you're paying your regular premium is $200 a month or $100 a month.
Let's say $100.
$100.
I'm just kidding.
Okay, nice.
Okay.
$100 a month. So overfunding is putting in more than what the minimum amount is.
Right.
So if you're paying $100, you definitely want to overfund it at least $100, at least. Just depending on how fast you want to see your money grow.
Right.
Okay. So on an IUL, anytime we get an IUL client, we show them what overfunding does for their money in the
major difference.
In the illustration.
I'm telling you, major difference.
And then the other thing, because we've heard of clients who have an IUL and they didn't overfund because of the cost of insurance, they ended up definitely not having any money in their policy. Right. So don't be that person and looking at us. You ain't gonna look at me, because I'm gonna tell you this is what it looks like. This is what you have to do to have that amount of money, the amount of money that you want to see.
Well, and a lot of people use these type of accounts as a savings account on steroid. You know what I'm saying? So instead of me putting, $500 a month into my savings account that I'm getting 0.00001, I'm putting it into my life insurance policy because it's compounding daily. So I'm getting a greater return. It's protected, so I can't lose. And if I need to go get it, I just go apply for a loan, and I ain't got to do no credit check. They ain't got to put no application fee, none of that. I'm just, okay, I need $10,000. Now you have to have that money in there.
Yeah, definitely have to have that. They're going to tell you what percentage you can get out. Right. Yeah. And there's a small little quick application. It's nothing major.
Oh yeah.
Because it's your money.
Exactly.
And they can't hold you from your money.
Right.
So yeah. So that's more. That's about the IUL. And then for the term policies, they're more. Well, let me talk about the whole life. whole life policies are what our moms and grandmoms have had in the past, where they still have a cash value that you pay into. But it just doesn't multiply as fast as the IUL. Okay. Because you're getting that extra 5%, 5.9, whatever the rate is for the year. Now they have a smaller percentage that they're going to give you. And I'm not sure what those are. Usually it's about 1%. Okay. So we don't really recommend those as much. Now there are some whole life policies.
That's a few
that are specific companies. They pay dividends,
right?
And the dividends are reinvested back into the policy. And so you're getting that plus whatever the interest rate is that it's paying. So there are a few companies that still offer that. And they are usually mutual companies that pay dividends.
Right.
We do have someone that we can use for that as well. But yeah, let's go into the term policies. Now,
let me add something right quick before you get into the term policies. Insurance companies has been around for, centuries. Centuries, 100 years, right?
Mm-hmm,
Yeah,
mm-hmm.
100 plus years. And you've never heard of one of these major insurance companies going under. Through wars, through the financial crisis, through depressions, whatever major financial incident or situation that happened, you don't hear of insurance companies closing like banks.
Major insurance.
Major, not these mom and pops, that some that started 10 years ago. We're talking about major that's been around for hundreds of years, 150, 170 years old.
Right.
They don't go out of business. They don't need a bailout. They really are the cornerstone of the financial institution, because a lot of banks now are invested into these insurance companies. As far as policies, because the money is protected. You know what I'm saying? So if they smart enough to get some IULs or some whole life policies, the right ones, it makes sense for you to really to do the same thing as well. Okay.
So now we'll talk about the term policies.
Term
are
temporary,
more like temporary policies, and they are just what they say. They go for a certain term, a certain number of years, 10, 20, 30 years. And the policy doesn't cancel, but it just becomes very, very expensive when it turns out, when it reaches that 30 years. So what you find is people may have these huge term policies that have aged out, and now the premium has gone up more than $1,000. And so they're not really affordable anymore. And then you're much older. So you're having to requalify for an insurance,
right,
a whole life insurance.
So you got diabetes and
you have
high blood pressure and all kind of stuff going on.
Yeah. So unless you just really at this time are strapped for cash, I don't really suggest a term policy. And a lot of people, find that this is more for them. And some people even harp on, I think, what's his name?
Dave Ramsey.
That's all he say, term and invest the rest. Term and invest. I just don't think that's wise. Long term.
No.
Long term.
It's not.
It's not. And then what about losing, what about the cash value that you could have built up? And then the compound interest.
Right.
They don't tell you that kind of stuff when you're in your 20s.
And then, how do I know what to invest in if I'm getting term and invest the rest? Stocks, bonds, Forex, or business, or?
Well, they have it set up mutual funds, and then Roth IRAs. Because some people, Roth IRA, you put your money in it, you can't get it out until you're 59 and a half, or you shouldn't. If you do, you will have a lot of taxes to pay on it. So, I just don't know about that. I don't agree with it. I wouldn't.
Well, I mean,
if you're a savvy investor, maybe.
Man, how many of us are savvy? Not many. I mean,
we're learning. We're learning.
We ain't got there yet. Okay, so until we get there, then we don't want to use that concept. But and we're not saying that don't use term under no circumstances, because it's better to have some life insurance than to have none at all.
Exactly.
And then I mean, a lot of the term policies can be converted to a whole life or IUL.
Yes. After you, when you start getting close to your age out and turn,
okay,
that they'll let you go ahead and convert it over, and then you don't have to qualify medically. So that's another plus about the term insurance.
Yes, it is. It is.
And then we have annuities. A lot of people have heard bad things about annuities, but annuities are really, really good. You can get term insurance. Now, this is just something I'm throwing out there.
It's an option.
That's an option.
Don't be saying that lady right there said.
Yeah. Term insurance, and then invest into an annuity.
Now, I mean, I can agree with that a little better than.
And then once your term turns out, you'll have the annuity money for burial, and then whatever you leave to your family. So that's some way that we can set that up as well. Annuities are becoming a little bit more popular than before. People just didn't know how they worked, and you have to be separated from your employer or retired in order to take advantage of. If you want to roll over something from a previous employer, you have to be separated from that employer for, I think, 3 months before the company that you have your retirement with will allow you to move it. So, it's really a good product as well. And if you can get it with a bonus for the first year, some have 12 to 15% bonus. That's a good kickstart to your retirement money. So that's something that we can also discuss with you as well. So how do you determine what determines how much insurance you get? I think you guys talked about that.
Yeah, we did briefly, but can I add something? Well, I want you to share some more light on something before you get to that piece of it.
Okay.
401ks. And once a person leaves their job, they can transfer this 401k into an annuity.
Right. They can roll it over into an annuity. That's what I was saying. You have to be away from that job for
okay.
I think it's 60 days, 30 to 60 days, something like that.
Okay.
And you can roll over that 401k and start it into an annuity. And like I said, with that first year, a lot of companies are paying a 12 to 15% bonus on your money. So if you have a pretty nice size 401k or 403b, that can roll over into an annuity too. So that you can still gain, allow it to grow over the course of the time.
So can a person do anything different with their 401k if they're still working that job? None at all. Until they leave.
Not until they leave and have been separated. Other than letting it stay with the company who you have it with, and let it build from there. But yeah, you have to be separated for that period of time before they'll let you do anything with it.
And the reason why I'm to keep talking about these 401ks because was it during COVID or right after COVID? You went to sleep and woke up and you were like, $12,000
yes,
less.
I was watching it during COVID because I was like, oh Lord, what am I gonna do? And then it just kept going. I think it was within a week's time, I lost $12,000.
That's crazy.
And I was like, oh So I had to quickly take it out of their investment accounts and just sit it into a stable fund until I figured out what I was going to do it with. So yeah, I ended up rolling it over because I had stopped working at the job for a while. So yeah. So I mean, we can have conversations,
Right. Yeah.
you know, because all situations are
They're
different.
gonna be different. Yes.
And so we definitely, if you are in that situation, definitely let us know and we'll see what's the best route for you. Okay.
And if you got somebody else, and we're not just trying to direct everybody to us, even though we are, but if you got somebody else that you know in the family or, that speak to a professional about your situation. That's the key right there.
Yeah.
Yes.
That's the key thing.
And we are professionals. Okay, sorry.
Anyway, he is so serious. Okay, so how do you determine how much coverage to get? So they talked about the 10 times to 15 times your annual income. That's just like if you're not sure, that's something that you can go by, 10 to 15 times your annual income. And then they have the dime method, which is your debt. You're adding all this up, your debt, your income, how much it is to pay off your mortgage, and educational costs for your children to attend college. And so once you get that figure, that will tell you about how much you need. But that leaves off, to me, living expenses, how much your family needs for a year, for however many years, before your baby is all ready to, leave the nest. And so those are a couple of ways to figure out how much insurance you may need.
I want to add something when you finish that.
Go ahead.
I think we need to talk about mortgage protection.
Okay.
Because there's a lot of people who own homes that don't realize that they could have mortgage protection on their house. So if they pass away or whatever, the house will be paid off. And then I guess there's a certain type of insurance that's really connected to that mortgage protection. If you can share that with them.
Oh yeah. So very important for you to know, when you get that mortgage, that PMI does not protect you.
No.
It does not protect you.
Zero.
That is strictly for the bank. Okay.
Protect their money.
If something happens to you, you're not able to pay your mortgage to them, or something happens and you stop paying, that protects the bank.
Yep.
And so what if something happens to you, you fall sick, and you can't pay your, or if you pass away, what's going to happen to your house and your family? So we have to help understand that private mortgage insurance is very important for you. Okay. And so you can get your own policy. It's simply a term policy that covers your amount of whatever you owe on your house.
Right.
Okay. And that's all it is a term policy set up for 30 years. So it covers the amount, the time that you're going to be in that mortgage.
Right. Excuse me.
And so you definitely want to consider that, because if something happens to you and your family or your family can't pay the mortgage monthly, then they're going to get probably foreclosed on and have to leave.
Well, and I mean, I know this from experience firsthand. My mother and my stepfather, they had a house built outside Chicago. Everything's going fine. A1 credit. They had the savings, all that good stuff. Had life insurance as well, but they didn't have mortgage protection or enough insurance to pay the house off. So when my stepfather passed away, it just left my mother. She couldn't afford to continue to live the same lifestyle because he was, I mean, she did well, I mean, for his income, but I mean, he was the kind of like the breadwinner type. And basically, I mean, he had retired, so good money coming in, good flowing, you know. But if they would have had mortgage protection, then she would have been able to keep the house. So she had to do a short sale on it. Had to file bankruptcy because of all the other, things that were going on financially. Once he went away. So um, I've experienced it, firsthand, and so we're just trying to get people better prepared because you don't know when it's going to happen. You don't know when someone's going to pass away, especially someone who is the breadwinner. It's going to affect the whole entire family and their lifestyle. Period.
So, and the breadwinner can have peace of mind when they know that they have set something aside
Exactly
to help in the event of an untimely death.
Yes.
And so
it's a good feeling.
And that's right, it's a good feeling. And one other thing that I definitely want to touch on, very important when you're dealing with insurance and trying to qualify for insurance, your health is your wealth. I've had so many people that I've had to pretty much say that, okay, I'm sorry, but this company won't insure you because you're over too much overweight, and then a young person too. So that's one thing that we have to start thinking a little bit more about. It can be a barrier to getting coverage. And so we have got to, and with the insurance companies, it's not the fact that you have diabetes. It's the fact of you not controlling your diabetes and your numbers being off. Because, they pull go to your doctor and get your numbers and get all this. And they know when your A1C is too high. They understand all that. So you're not dealing with people that don't know. They've been in business for hundreds of years, so they know what they're looking for.
It might be.
And the other thing is your credit.
That's me right there. Credit, yeah.
Yeah, that affects your rates on your insurance.
All platforms of insurance.
Yes, all platforms. So why don't you talk about a little bit about how the LexisNexis and how these low credit scores, or having stuff in collections from insurance companies that you haven't paid. Yeah.
Well, when you talk about life insurance and our premiums, whether it be auto, whether it be home, whether it be life, whether it be health, they pull your credit. And your premium is based on, a part of your premium is based on your credit score. So that means that you have a low credit score, you're going to be paying more in your premium than someone who has good or excellent credit. That part is going to be important for us to be able to understand. And I talked about this in our class last night. How much does bad credit cost you? That's one of the ways that it does cost you based on your insurance premiums. Very, very, and over time, that could be thousands of dollars that you're spending, or not being able to qualify, based on your credit. There are several other credit bureaus besides Equifax, TransUnion, Experience that you need to actually look into. LexisNexis is definitely one of them. LexisNexis is the largest third-party database company in the world. So all your insurance is listed. All your criminal information is listed. All your employees' addresses, stuff that don't come on your credit report, like maybe some type of child support or liens, background. And it's about this thick when you get it. Very thorough. How long you been at this address? I mean, everything is actually there. So you need to get a copy of that so you can see what other people are looking at. Then the other one that she's talked about as far as them keeping a track of your medical is your MIB, Medical Investigation Bureau. Anytime a doctor, you go to a doctor's office, anytime you do have a hospital, any kind of medication you on, it's in this file that they pull up, and you can get a copy of that for free. It used to be free; it might be $12 now with inflation. But you need to get a copy of that so you can see what's on it, see what the doctors are looking at, see what the insurance companies, because they're gonna pull this report. They ain't gonna tell you they're gonna put it, but they're gonna put it. And so you need to be better prepared for situations like that, especially when you're looking for medical, etc.
And then also they pull a prescription report. So whenever your doctor gives you a prescription, you take it to the pharmacy and it's filled, even if you never took.
Right.
Even if you've never taken the medication, it's in your report. Okay. So I've had people say, well, I don't take that. I've never taken that, but you got it filled and it's in your report. See, they have access to a lot of things that we didn't know until I started doing the insurance. And I was like, man, they can get everything and they can get it quick. They have all these bureaus and these different things. Your MIB, the doctors, whatever they put in your chart, they submit that over to the MIB, whatever their notes are.
Yep.
I had a patient, a client that was denied, and he didn't even know what was in there. So he got a report from MIB, and he went and took it to his doctor and was like, "What is all this?" So I mean, and a lot of it is not, you're not being treated for, but they have put these things in there. But you have a right to the record so that you can look at it and dispute it.
It's yours.
So we have some comments here. Let me look. Let me see. What does IUL stand for, Herbert? Hey, IUL stands. It's a UL. It's Index Universal Life. Index Universal Life. Okay, yes. And that is, they use that's a infinite banking. That's the policy that they use to help you develop the whole concept of infinite banking.
Right. Yeah. Your own personal private bank. Yeah.
Private banks. The money. It's just you get to use the money however you want to. You don't have to qualify.
Right.
So you're your own bank. And then Herbert says, if you are getting close to retirement age, what life insurance should a person get? Okay.
Well, we hope you got some insurance already.
It determines on what it is that you're wanting to do, what you're trying to do, Herbert. If you are wanting to get a policy just for coverage, death benefit coverage, or if you still want to build cash value. So it just depends on, your situation and what you're trying to do.
Right.
One thing I'll tell you, if you're getting close to retirement age, that you are, a little older, so it's going to be a little bit more expensive to get an IUL or a whole life policy. And then if you are 65, on the term policies, you're probably at the max for the 10. I think they may go 10 to 15.
10, yeah.
So it just depends on what you're trying to do. Okay, a term policy through your job. Now, understand this.
Once you leave that job,
you don't have any coverage. Once you depart from the job, of course, I'm sure you understand there's no coverage.
Right.
So you definitely need to get into. I mean, you can get a regular whole life policy too.
Yeah.
Like Mutual of Omaha offers that living promise.
Right.
Yeah, it just depends on what your budget is.
Right. Yeah.
And what you can afford to pay.
Well, and based on what you stated is, I mean, what are you trying to do? Are you trying to get, $20,000, $25,000 for burial? Or are you still trying to be able to create some cash value inside of a policy? Those are some of the things that, I mean, it's a case by case scenario. And we would love to have a conversation with you if you want to reach out to us, or Dr. Wright to pass it on to us, and we'll be glad to look at it for you.
Yeah, and then I want to really hone in on this insurance with the job. You should always have your own personal private policy.
Yes.
Because you don't know, okay, if something happened to you, most people, first of all, they don't even know the company that the insurance is through.
Right.
So that right there is telling you it's going to be a problem. Sometimes they take up to a month or 2 months to pay out.
Right.
You need your own personal policy.
Yes.
Even if it's a small policy, just enough for burial. Just to get your funeral expenses paid for. Because you don't know the job policies. I'm telling you, they are not dependable.
And then, I mean, a lot of people don't even know how much life insurance they have with their job. I mean, it could be 10, 20.
I mean, a lot of times it's being deducted from your paycheck. Usually that's the case.
Oh, yeah.
I think with those are considered group policies. Right. They go in, they give you a group rate, which is supposedly a discounted rate. Right. But you got to understand that nobody ever reads the fine print of these policies, and you don't know how it really works. Nobody probably calls the companies to find out, the backside of the policy, or what's really going to happen if something happened to me.
Always get your own.
Always have your own personal policy.
Right. Definitely.
It's just good business for you. It's smart planning.
Because as soon as you leave that job or retire or get fired or quit, that policy is none and void going forth, because you can only get it through the job. If you're not still there, then you can't get it. So very, very good point there.
Yes.
I like that. So, okay. Anything else you want to share as we wrap up here?
Well, I just encourage you guys to please talk with somebody about insurance. It's very important to get it. The earlier you get it, the better.
Right.
Okay. Grandparents, you can get it on your grandchildren. That's one thing that we didn't talk about.
Sure did not.
Covering your grandchildren.
Even your children if they're younger.
And your children, yeah. I mean, even if they're older.
Well, not be like 50 or 60.
No, we ain't doing that.
But yeah, younger children, I mean, that's one of the things that they do is when they're any wealthy family, whenever there's a child that's born in that family, they have to wait 2 weeks. After 2 weeks, they putting $1 million, $5 million on these children, on these babies, but they overfunding it. And they dropping 10,000 here, 5,000 there, 1,000 there. So by the time they get 16, 17, 18, man, they might have $300,000, $400,000, $500,000, $1 million in this cash value that they control.
Grandma controls.
Grandpa
controls.
Yes. Okay. We have policies on our grandchildren too.
So, legacy, building legacy in life insurance.
And that's how this infinite bank coming in, because if I got $400,000 or $500,000 that I have access to go and get, we ain't going to no car dealership paying no 12% interest for no car. No, we're going to go loan you the money out of we the bank, and you're going to pay us half of that interest, 6% instead of 12.
Yes. And
we're going to put that money back in. So when somebody ready to go get a down payment on their house or buy a house, we're going to have all that already set aside. College funds, we ain't going no student loans. We're going to our infinite bank, pull the money, Here you go. Start a business. You need 50,000. Okay, and I need to see a business plan though. Okay, all right. Take that money and drop it in. So we're really missing out on a great opportunity by leveraging the right type of life insurance policy. Definitely.
And this country was founded on life insurance.
Man, look at Walt Disney. Look at Master P. Look at all these other individuals who use life insurance to fund their
dream.
Yeah, it wouldn't have been no Walt Disney World without life insurance.
That's right. And Master P, he has a testimony.
Oh
about,
yeah, he talks about it all the time.
That. Look it up. His
grandfather
on YouTube
left him some money when he passed. That's how he started. Ghetto Records? No,
I don't know the name of it.
Okay, Master P's label. Yeah, no limit, no limit soldiers.
No limit records.
Limit.
That's
okay.
right.
Yeah.
Anyway.
So I mean, definitely you need to take advantage of that. He has one more. He has no cost, 25,000 term.
Oh, you definitely need to check into that, brother, because I don't know. Is it at no cost too? Who paying for it?
Yeah. Find out about that policy. Who is the owner of the policy? I mean, the company, and to find out if it's truly really no cost to you. 25,000, but you got to think, and you stated that you're getting close to retirement age. So once you retire, that 25 ain't there no more.
That's right.
So you might need to start looking at some other options now in that situation. But definitely, man, we got to fund these cash value policy with our children and our grandchildren because they're younger. I'm 61, so it costs. I mean, we have life insurance, of course, but if I want to go get an IUL for, X amount of dollars, it's gonna cost me my right arm. But grandchildren, they 3, they 1, they 4. Put it in them, overfund it. If they need something, it's there.
See, now you have to pay attention because you have to think about it in a different kind of way. It's not covering you. It's covering the grandchildren.
Right.
You're funding it so that you'll be able to help the family and help the children. Once it reaches a certain, you're able to see your cash value grow. So that's how it works. You're funding it, which means you're paying for it and you're putting the extra money into the policy.
And you control the policy.
Grow it, so that you'll have access to the money. And then your grandchildren, later on, you can help them do some things. So that's how that's going to work.
And get a trust. Got to have a trust. But that's another episode.
That's another.
Yeah. Hey, Michael, that's another conversation talking about trust, and the right type, and why it's important to have that set up as well. So, should I look into State Farm life insurance because they cover our house? Yeah, I mean, that's a possibility for you to start.
You got to shop your quotes.
Yeah, but just don't go with them because they got your house and your car. But ask them for a quote, and ask them what is the best option that they feel that you need to go right now.
With you being close to retirement age.
And we're still here, my brother. We ain't gonna charge you for just have a conversation with you. Reach out to us. We are professionals. We'll guide you in the right direction. But definitely, check with State Farm and see what they have to offer for you.
That's right. Okay.
I think our time is up.
We enjoyed you guys.
Yes.
Thank you, Herbert, for talking with us and asking questions.
Yes.
We appreciate all the questions. Hope we answered everything fully.
Yes. And wherever you are, Dr. Wright, don't be there next week. We appreciate you, brother.
Thank you all so much. Have a good night. We appreciate it.
Always a pleasure. Thank you.